Do you really think parking money in the bank or dumping capital into the stock market will deliver compound growth and let your assets earn money while you sleep? Reality is delivering a harsh wake-up call to everyone. Right now, the world's sharpest minds, the tech pioneers on the frontier of AI innovation, are pulling off a counterintuitive, massive shift. They are selling tech stocks at an unprecedented pace, then turning around and pouring all cash offers into luxury real estate in core global cities. In South Korea, over 60% of the 3.7 trillion won freed up from stock sell-offs flooded straight into Seoul's housing market. Over in Shenzhen, China, sales of luxury homes priced above 30 million RMB surged 154% year-over-year. Here in Silicon Valley, AI new money converts equity holdings into property. A staggering 42% of high-end real estate transactions are all-cash purchases. Why do these elites with top-tier resources and front-row access to tomorrow's trends collectively pivot away from tech and lock their wealth into seemingly old-fashioned concrete and steel? What fatal bubble are they seeing that ordinary investors miss? America's fourth major real estate wealth boom is quietly underway. Spend the next 10 minutes understanding this capital signal, and it could be your only playbook to preserve wealth or even climb the socioeconomic ladder amid this massive wealth reshuffle. If you trace global capital flows right now, you'll spot an eerie, counterintuitive trend. Whether it's Dongtan near Seoul's semiconductor hub, where home prices jumped nearly 50% in 9 months, Shenzhen's first-quarter luxury home sales above 30 million RMB, rising 1.5 times year-over-year, or the San Francisco Bay Area, where 42% of properties worth $2.05 million plus are bought outright by AI employees. These tech innovators, sitting at the epicenter of technological progress, are following the exact same playbook. Earn global profits powered by AI, then lock every dollar firmly into physical real estate. It sounds irrational, doesn't it? Technology represents the future, and AI growth is still accelerating. Why walk away to pile capital into real estate, an asset class many write off as outdated? To crack this code, we first need to understand the valuation original sin of tech companies. Traditional brick-and-mortar businesses carry tangible, grounded market valuations. Their worth is built on factories, inventory, land holdings, and consistent annual net profits, hard assets stacked one on another. Even when market sentiment sours, those physical assets remain. Their market cap cannot vanish into thin air. Tech firms operate by an entirely different set of rules. Most run asset-light business models with little tangible collateral to prop up their valuation. Their price tag hinges entirely on projected future growth, proprietary technological moats, and market optimism. Simply put, tech's sky-high valuations mean Wall Street pays upfront for promises of tomorrow. Take SpaceX's astronomical valuation. It's not driven by how much cash SpaceX generates from rocket launches today. Elon Musk sold global investors a transformative grand vision: human colonization of Mars, reusable rockets flying as routinely as commercial airplanes. Investors pile into this powerful narrative, fueling extreme valuations and lucrative stock options. But make no mistake, until you convert those holdings into cash, all of that is just fragile paper wealth. Assets built on futuristic stories are far more precarious than most realize. Once a tech company's narrative collapses or it fails to deliver new technological breakthroughs, employee equity can turn worthless overnight. Stock options become scrap paper, and corporate valuations implode in a single trading session. We're seeing this play out in 2026. It's common to see US tech stocks crater more than 30% in a single session on shifting market expectations. One day you're celebrated as a multimillionaire, the next you could fall out of the middle class. Paper wealth evaporates without warning. Do you think the tech new money operating inside the AI revolution, surrounded by algorithms and data every single day, fail to grasp this truth? They understand it better than anyone. They know just how ephemeral their paper fortunes truly are. This is why the world's sharpest investors are executing a highly calculated wealth leverage play, bet big on the sector while the hype cycle peaks, pushing company valuations and personal option packages to stratospheric heights. Once they hit their target, they don't linger. They cash out at the peak as fast as possible. What happens after the exit? Buy more tech stocks? No, they convert those fragile digital valuations into something secure, immutable and impossible to erase, physical tangible assets in the real world. That explains why premium real estate in top-tier cities has become their unspoken consensus choice. Stock options can hand you a shot at windfall gains during market booms, but only once you swap those shares for tangible land and buildings does that massive fortune truly belong to you, realized gains locked down. You might ask, if they're seeking safety, why aren't these elite investors loading up on gold or commodities instead of pouring money into luxury homes? Premium residential real estate stands out as an ultimate safe haven asset, supported by four unshakable fundamental pillars. First, tangible asset anchoring. All virtual assets derive their value from collective belief. When panic spreads and confidence crumbles, prices can crash to zero in hours. Real estate is different. It's backed by land you cannot replicate, physical structures you can see and touch, and irreplaceable location value. As long as the city stands and the building remains, its physical value will never hit zero. That's genuine security. Second, innate inflation resistance. Global central banks will keep unleashing liquidity to stimulate economies. As currency printing devalues cash, your money in the bank loses purchasing power day by day. Real estate acts as a massive wealth reservoir. When fiat currency loses value, property's nominal price rises in tandem. It hedges against systemic risk, money turning worthless. Third, intrinsic utility and cash flow defense. A share of stock cannot shelter your family, and many equities pay no dividends. Real estate serves dual purposes. On offense, it delivers premium living standards for you and your household. On defense, luxury homes in prime locations are scarce, generating steady, substantial rental cash flow. During market crashes and tech industry layoff cycles, owning a rent-producing prime property gives you an unbreakable financial safety shield. Fourth, the most transformative advantage, absolute scarcity for luxury core real estate. Face a brutal reality. With sufficient capital, new tech startups and AI models can launch anytime. OpenAI exists today. Google and Anthropic can emerge tomorrow. Technology gets iterated, and corporations can issue unlimited new shares. But developable land in prime urban districts is finite. Every parcel sold removes one more opportunity. Central development zones in leading cities are nearing full build-out, and new luxury housing supply shrinks year after year. Meanwhile, the AI boom keeps multiplying the population of high-net-worth buyers flooding in. Demand keeps climbing, supply keeps tightening. This severe supply-demand imbalance guarantees premium luxury real estate will hold its value long-term and widen the wealth divide between ordinary housing and elite properties. To distill everything into one sentence, tech stocks and equity options create opportunities to earn generational wealth during market booms. But in this era of constant uncertainty, only hard assets like real estate let you lock in your profits and build intergenerational wealth barriers. At this point, many viewers will think, wealthy people buying luxury mansions doesn't affect me. I can't afford a Manhattan penthouse or an estate in Silicon Valley. This is the cognitive barrier stopping most people from ever crossing class lines. Over the past 2 decades, every major U.S. real estate boom, on both the West and East coasts, follows a cold, clear, repeatable capital transmission chain. Federal Reserve cuts rates and expands liquidity. Right arrow, the top 1% capture fresh capital. First, right arrow capital flows into scarce luxury real estate. In prime neighborhoods, right arrow luxury home appreciation lifts area-wide land premiums. Right arrow price spillover pushes up mid-tier upgrade housing and entry-level homes. Right arrow finally driving broad market growth nationwide. This is not just abstract theory. Let's revisit three pivotal U.S. housing cycles and examine hard data to see how wealthy investors capture the upside, while everyday households get pulled along for the ride. The first wealth wave emerged from the rubble of the 2008 subprime crisis. In 2009, the Federal Reserve rolled out unprecedented quantitative easing, slashing interest rates close to zero. Ordinary Americans were terrified, convinced U.S. real estate was permanently broken. Meanwhile, top hedge fund managers and billionaires deployed cheap borrowed capital to snap up luxury properties in Manhattan and Los Angeles. Between 2010 and 2012, while mainstream residential housing remained stuck in a slump, luxury Manhattan home sales surged, with average prices rebounding more than 30% against the broader trend. This bull run in luxury real estate sparked market confidence. Capital spilled over into entry-level housing. By 2013, the S&P CoreLogic Case-Shiller U.S. National Home Price Index posted its largest annual gain since the crisis. Luxury real estate was the first signal lighting up that cycle. The second wave belonged to mobile internet and tech unicorns, 2015-2017. The U.S. stock market entered a massive tech bull run. IPOs and equity compensation created thousands of young tech millionaires. These investors made the identical move we're watching today: cash out equity at peak valuations and submit all-cash offers for limited housing in Silicon Valley. Around 2015, properties in Atherton and Palo Alto, America's most expensive zip codes, were snapped up by tech professionals. Prime neighborhood home values doubled within 3 years. This frenzy created a ripple effect. Billionaires purchased the top-tier estates. Wealthy families, pushed out by rising prices, chased secondary suburban communities, lifting the value of affordable starter homes. The buying spree ignited by tech investors ultimately heated up housing markets across California's tech hubs and the rest of the United States. The most recent, explosive third cycle, the unlimited liquidity surge of 2020-2022. Global economic shocks forced the Federal Reserve to inject trillions of dollars into markets within days. Zero interest rates and remote work triggered the largest wealth migration in modern history among Wall Street executives and tech leaders. Investors brought stock market windfalls and flooded Miami and Austin. In 2021, sales of luxury homes valued above $10 million in Miami jumped an astonishing 101% year-over-year. The ultra-wealthy completely tilted the supply-demand balance for elite property. The ripple effect spread outward rapidly. Seeing billionaires aggressively purchasing real estate, everyday Americans feared runaway inflation and rushed into home buying. By late 2021, the U.S. median home price hit an all-time high, jumping nearly 20% in a single year. 2009 Wall Street bottom fishing, 2015 Silicon Valley equity exits, the 2021 Miami real estate frenzy. History repeated itself 3 times across North America, following the exact same script. Luxury property rallies first, wealthy investors move early, wealth effects ripple outward, lifting the whole housing market. Pull back from history and focus on our present moment in 2026. After 5 to 6 years of elevated interest rates and broad asset corrections, the gears of the global housing market clicked into place at the start of this year. If you pay close attention, the 2 definitive bull market signals that drove the last 3 U.S. housing booms have arrived simultaneously. First, monetary policy is shifting back to easing. Fresh, cheap liquidity is flowing back into global markets. Second, the market leading indicator has flashed green. Luxury real estate hubs centered in Silicon Valley and Manhattan have rebounded first, with first-quarter transaction volumes doubling. History does not repeat verbatim, but it always rhymes. Standing at this crossroads in 2026, the 4th major real estate wealth cycle is entering its critical opening phase. Based on the housing cycle patterns we reviewed, the trajectory of wealth flows is clear. AI founders and top executives selling tech shares to buy luxury homes are the stone hitting the water. Right now, supply and demand for premium luxury real estate have tilted sharply upward, pushing prices higher. Next, the ripple effect will spread outward without pause. As top-tier luxury homes become unaffordable, displaced affluent buyers will shift capital to mid-tier upgrade properties. Eventually, starter homes gain pricing momentum. This wealth cascade flows downward, ultimately lifting overall housing prices in major global core cities. This is the visible, accessible generational opportunity waiting for ordinary investors. So what can everyday people do, without stock options and multi-million-dollar equity windfalls, amid this massive wealth reset? One core principle stands above everything. To build wealth, follow the most sensitive, sharpest investors of this era. You don't need reckless speculation. Without insider information, avoid gambling your life savings on volatile tech trends that can crash 30% overnight. Don't get trapped as the final buyer when the AI bubble pops. AI researchers, chip executives, and elite tech insiders have already completed the world's most expensive market research, backed by billions in real cash. Their decision to sell equity is not herd behavior, they've decoded the economic cycle. For regular investors, align with this capital flow. Target high-quality real estate in major core cities with prime locations and irreplaceable scarcity. This is the most stable, secure investment path that balances downside protection and upside growth amid widespread uncertainty. Catch this newly launched housing cycle, and you don't need to be a tech genius to capture the wealth spillover from the AI revolution. The world's smartest billionaires are converting digital paper wealth into tangible concrete and steel. Do you believe this luxury housing boom driven by AI new money will lift mainstream starter home prices just like the 3 prior US cycles? With cash set to lose purchasing power, what asset class will you choose to protect your wealth? Drop your thoughtful analysis in the comments below. I will engage directly with your ideas. If this video helped you uncover the hidden wealth flows and economic cycles the elite rarely discuss, hit the like button, subscribe to the channel, and turn on notifications. When global capital shifts dramatically next time, you'll receive in-depth analysis the instant it lands. I'm your wealth observer. See you next time.